Let me tell you something that most people in the trading industry don't want you to know. The market isn't random, it never was. Every move that you see on a price chart, every spike, every reversal, every pullback, is the result of a coded system, a program, an algorithm that was specifically designed to move price from one level to the next in a very precise and predictable manner. And here's why that matters for you. Because if the market moves on a program and you understand how that program works, you can actually anticipate what it's going to do before it does it. Think about that for a second. Every trader you've ever seen sitting in front of multiple screens, staring at indicators, trying to predict the next price move. They're trying to solve a puzzle without knowing the rules to the puzzle. And you're about to learn the rules. The books teach you support and resistance. The YouTube channels teach you how to read candlestick patterns, and the courses teach you indicators. And none of it is based on how the market actually works, because the market wasn't built for retail traders. It was built by institutions, run by algorithms, designed to move price in a specific way, at specific times, to specific levels. And for the longest time, that information was only available to people on the inside, the institutions, the funds, the people who wrote the code. But that's changed because a framework exists now that reverse engineered how these markets actually move, and it's called ICT. And what it gave retail traders for the very first time was a way to see what's actually happening behind the price chart, not with indicators, not with patterns, and not with guesswork, but the actual price mechanics. Why price moves where it moves, who's behind it, and what it's reaching for next, and more importantly, when. My name is Ali Khan. I've spent a decade studying this, and I've dedicated my career to understanding how these markets are coded and teaching it in a way that actually makes sense and is a little bit more digestible. I've worked with hundreds of traders, from complete beginners to people who have been trading for years and still couldn't find consistency. And the one thing that I found every single time is that when somebody finally understands the foundation, everything changes. Not gradually, but immediately, because once you see the market for what it actually is, you literally cannot unsee it. If you're brand new to trading or you've heard the term ICT and you have no idea where to start, you're in exactly the right place. This video is going to give you the foundation, the thing that everything else is built on. And by the time we're done, you're going to understand why price moves the way it does, what the market is always reaching for, and how a coded algorithm delivers price in a way that, once you understand it, makes the market feel less like chaos and more like clockwork. This is your starting point, so let's get into it. So the first thing that you need to understand, and this is the thing that changes everything once it finally clicks, is that price isn't random. Most people come into trading and they look at a chart and they see this wave of candlesticks going up and down, and they assume that what's driving that movement is buyers versus sellers. If there's more buyers in the market, price goes up, and if there's more sellers in the market, price comes back down. That's what every trading book out there teaches us. And that's what every retail educator out there tells you. And it's not just wrong. It's the exact reason why most traders never make money. Because if you believe that price is driven by random buying and selling pressure, you'll spend your whole career trying to predict something that's unpredictable, and you'll keep losing. Now, I want you to think about something for a second. The financial industry is the largest industry on earth. We're talking about trillions moving every day through these markets. Do you really think that the people behind that, the institutions, the central banks, the largest funds in the world, do you really think that they would leave the movement of all that money just to random buying and selling pressure, just to random human emotion? Of course they wouldn't. The markets are a business, and like any business, they run on a system. That system is an algorithm, a coded program that delivers price from one level to another based on time and price, regardless of how many retail traders are buying or selling in the background. Now, I know some of you hearing that for the first time might be skeptical, and trust me, I was too. When I first came across this idea, I pushed back on it because everything I'd been taught told me that the markets move on supply and demand. And the more I studied, the more I went back through historical charts, the more I saw the same things happening over and over and over again at the same times to the same levels. And you simply just cannot explain that happens by random buying and selling pressure. There's something absolutely mechanical happening behind these markets, and the sooner you accept that, the sooner you can start working with the market instead of against it. Let me show you what I mean on the charts. So here's a price chart. Price isn't just bouncing around randomly, right? If you look closely, you can see that price is moving between specific reference points, right? It sweeps up here above this old high, then it reverses, it comes back down into this area here, and then it moves up again. That's not random. That is the algorithm moving price from one reference point to the next. And when we get into individual concept in this series, I'm going to show you exactly how to identify those reference points before price even gets there. So you're going to want to subscribe to this channel. But for now, I just want you to look at this chart with fresh eyes. Forget everything that you think you know about support and resistance. Forget about trend lines, forget about indicators. Just look at structure. Price moves to a level, it reverses, comes back to a level, reverses again. That's the algorithm at work. And your job as a trader is simply to understand where those levels are and position yourself accordingly. Now, here's what makes this so powerful, because once you understand that there's a system behind the movement of price, you start feeling like the market is working against you because it's not personal. The algorithm doesn't know you exist. It's just doing what it's coded to do. And your job is to understand the code well enough to anticipate what it's going to do next. And that's literally it. That's what ICT trading is at its core. Now, let's talk about what the algorithm is actually coded to do, because this is where everything just starts to get way more simple. Here's something that took me years to simplify, and I genuinely wish someone had taught me this when I first started, because it would have saved me an enormous amount of time and money. Price only ever does two things. Number one, it moves to liquidity, and number two, it moves to balance inefficiencies, and that's it. I want you to really let that land for a second. Not 10 things, not 20 setups that you need to memorize, literally two things. Every single concept within the ICT framework, every model, every entry technique, every setup is built on top of those two things. When you're confused about what the market is doing, come back to that. Is price moving towards a liquidity pool, or is it moving to fill an inefficiency? Those two questions will give you more clarity than absolutely anything that you will learn in this space. Now, let me explain what I mean by each of them. Liquidity is essentially a concentration of orders, specifically stop-loss orders from retail traders. When a large enough pool of those orders build up in one area, the algorithm will move price towards that area to collect them. And an inefficiency is an area where prices move so quickly in one direction that it left a gap, or what we refer to as an imbalance, where only one side of price delivery was offered. The algorithm has to come back and fill that gap because it's been coded to deliver price fairly. If buy side is offered through a range, then sell side has to be offered back through that range. Both concepts I'm going to teach much deeper on throughout this series, but right now I want to show you both of them on the chart so that you can see what they actually look like in real price action. Quick one. I've been working on something that I've never really done publicly before. I'm running a 5-day live challenge called the High Probability Trading Challenge. Creative, I know. And I'm going to teach the exact process I use to look for any setup on any pair in any session, and know it in under 5 minutes, whether it's worth my time or not. This is the same framework I've kept close to my chest for years and only ever really taught it inside of my private mentorship. On day one, I'm showing you why 80% of the order blocks and fair value gaps on your chart right now were never going to work and how to spot the difference. And once you can see which ones were never real, day two gives you the 3 condition checklist I run before I ever risk a single dollar. From there, day 3 is where we take that checklist and I show you how I find the single highest probability trade of the session in under 30 minutes. Then day 4. I'm going to read the tape live and you're going to see exactly how I apply everything in real time. In day 5, you're going to be building your own personal trading plan around your pairs, your session and your schedule. Now, tickets are capped because we're running this live on Zoom, and Zoom does have a capacity limit, so it's a first come, first served basis. Early bird tickets are live right now. Click the link in the description, grab yours before we hit capacity. Right, let's get back to it. So again, I want to point out two things here. First, up here above this old high, you can see this area where price has been before, right? This is called a liquidity pool. All the traders who sold at this level, their stops are sitting just above this old high. The algorithm is going to come up here, sweep those stops, collect that liquidity, and then use it to facilitate the next move. Now, look down here. You see this area where price moved very quickly in this direction, leaving this gap between this candle and this candle. That's called an inefficiency, or something that we refer to as a fair value gap. And price is going to come back to fill this because the algorithm needs to offer opposing delivery back through this range. So you've got two magnets on the charts right now, one above and one below. And understanding which one price is going to move to first and why is what we're going to build towards throughout this series. But the key takeaway right now is that these two things are always going to be on your chart every single day, every single market, every single time frame: liquidity and inefficiencies. And that's what you're always going to be looking for. Now, you might be wondering, okay, Ali, so how do I know which direction price is going to move? And that's exactly the right question, because identifying liquidity and inefficiencies is literally just step one. Understanding context, understanding where you are in the bigger picture, that's what tells you which direction price is likely to reach for. And that context comes from understanding the dealing range. Before we get there, let me go deeper on liquidity, because this is the concept most people really underestimate. Let me ask you something. Where did you learn to put your stop loss? If you've done any kind of basic trading education, you were probably told to put your stops above old swing highs and old swing lows. And that's literally the standard advice. It's in every book. It's taught in every beginner course, and it makes sense on the surface, right? You're putting your stop at a level where the market has reversed before. But here's what nobody tells you. Every single trader who learned that same exact advice did the same thing that you did. They put their stop in the same place, above that high and below that low. And now you have a massive concentration of orders all sitting there at the same level. Now, let me show you this on the chart. So here we have a swing high. Now, a swing high in its simplest form is just basically three candles. The middle candle has a higher high than the candle to the left and a high than the candle to the right. And that's it. But what that swing high represents is a concentration of orders, because every trader who is short at this high and below has their stop sitting just above it. And every trader who missed the short has a buy stop sitting just above it, waiting to get in on a break. All of that is liquidity. And the algorithm is going to go up there, sweep those orders, collect that liquidity, and then use it to move price in the intended direction. Watch what happens. Price comes up, breaks above the high, triggers all of those stops, then it reverses. That's not a false breakout. That is the algorithm doing exactly what it was designed to do. It needed those orders, it collected them, and now it moves. Now, let me show you something even more important. When you have two highs at roughly the same level, what retail traders call a double top, this is what I call a liquidity pool, because every trader who's been taught to sell double tops has their stop sitting just above it. The more equal those highs are, the more liquidity is resting above them. And the more the algorithm is going to be attracted to that level. Think of it as a really strong magnet for price. So whenever you see a double top on your chart, don't think of it as resistance. Think that's where the orders are, and price is probably going to reach for them. There it is. Price sweeps above those equal highs, collects all that buy-side liquidity, and then the real move begins. Now, here's what this means for trading. The moment you start thinking about liquidity instead of support and resistance, your whole perspective shifts, because instead of asking, will this level hold, you start asking, where are the orders? Where is the market likely to reach before making its real move? And when you can answer those questions, you stop being the person getting stopped out at the top of the sweep. You start being the person who anticipated the sweep and position themselves for what comes after. Now, there's one more thing I want to show you on the chart before we move on, because liquidity doesn't just sit above old highs and below old lows. It's also engineered. This is something I want you to really pay attention to, because this is one of the ways retail traders get manipulated on a daily basis. So you've probably been taught about trend lines. You draw a line connecting the lows of an uptrend and you see that as a dynamic support and resistance level, right? Every time price touches a trend line, you buy it and you put your stop below the previous low. Now, look at what's happening here every time price touches this trend line. Every single touch, retail traders are placing their stops below these lows. Every single touch, the market is engineering more and more liquidity below those lows. It's literally a waving flag. It's telling retail traders, put your stops here. And then it takes them all out. Every stop below every single one of those lows triggered in one move. That's not a trend line breakdown. That's the algorithm collecting engineered liquidity. It's literally engineering liquidity in the form of that trend line. And then watch what happens after. Price reverses because that's what it was always going to do. The trend line wasn't support. It was a mechanism to collect orders. And this is the game. And now you're going to start seeing it. Now you understand where liquidity lives. Above old highs, below old lows. Equal highs and equal lows, along trend lines. These are the places the algorithm is always going to reach for. And when you can identify them, you can stop being the liquidity. Now, let's talk about the second thing the algorithm moves towards, inefficiencies. So we've covered liquidity. Now, let's talk about the other thing the algorithm is always moving towards, inefficiencies. And the main inefficiency you need to understand, the one that is going to become your most powerful tool as a trader, is by far the fair value gap. Now, this is a concept that gets overcomplicated online. Most people make it seem like this is an advanced technical pattern that requires years of experience to identify. It's not. It's actually one of the simplest things on a price chart once you know what you're looking at. Let me break that down. The algorithm has been coded to deliver price fairly. That means for any given range of price, both buy-side delivery and sell-side delivery must be offered. Price going up and price coming back down through the same range. That's efficient price delivery. When price moves so aggressively in one direction that it only delivers one side of the market, that gap that's left behind is an inefficiency. It's a fair value gap. And the algorithm will always come back to fill it because it has to. Fair value is the rule. Let me show you exactly what that looks like. So here we have this fair value gap, and I want to walk you through exactly how to identify it. Essentially, you're looking for three candles. Candle 1 is here, candle 2 is here, and candle 3 is here. Now, candle 2 in the middle, that's your displacement candle. First, look at the size of it and look how aggressively it moved in this direction. That's an algorithmic signature. That's the footprint that tells you that something's happening behind the scenes. Now, here's how you identify the actual gap. This gap sits between the high of candle 1 and the low of candle 3. Inside that range, price only moved in one direction. There's no opposing delivery here, right? That's the inefficiency. That's what the algorithm needs to come back to balance. And inside every fair value gap, there are three levels that you really need to know. The top of the gap, which is the premium high, the midpoint here, we call this a consequent encroachment, and the bottom of the gap, that's a discount low. These inefficiencies and fair value gaps in the market, price will gravitate back towards them as a drawdown on liquidity. So they will act as a magnet to pull price either lower if they're below the market or higher if they're above the market. Now, here's why the fair value gap is so powerful. It's not just an entry point, it's a tool for reading market strength. Every time price comes into a fair value gap, it's giving you information. And the body's closing above the midpoint, that's strong. If the body's closing below it, that's weak. Is the lower half being untouched? Very strong. The market is in a hurry. These signals stack on top of each other, and the more you can read them, the better you can trade and your decision-making process becomes, right? Now, I'm going to go much deeper on fair value gaps in a dedicated video in this series because there's a whole lot more to cover. There's different types of gaps, how to use them for entries, how to use them for targets, how to identify the high probability ones. But for now, you understand the concept, right? Price leaves an inefficiency, the algorithm comes back to fill it, and the midpoint tells you how strong or how weak the market is. There's more to it, but we'll get onto that, right? Anyway, let's move on. This is the concept that changed everything for me personally. And I'd argue it's the most important thing in the entire video, because without this, you can still know every single concept and still not know when to use any of them, right? So it's called the dealing range, and it's the framework that gives you the context for everything else. Here's a simple version. A dealing range is the price range between a swing high and a swing low. And after the market has swept liquidity on both sides, it sweeps the high, collects buy side liquidity, sweeps the low, collects sell side liquidity, and everything in between those two extremes is essentially the dealing range. That's the container, that's the area the algorithm is now going to operate inside. And inside that container, there are three things that you really need to identify: the high of the dealing range, the low of the dealing range, and the midpoint of the dealing range. The midpoint is equilibrium. It's the fair value price, the halfway point between the highest price and the lowest price. And from that midpoint, everything divides into two zones. Above equilibrium, that's premium, and below equilibrium, that's discount. Let me show you this on a chart. So here we have a dealing range. This is the dealing range high, and this is the dealing range low. Now notice what happened up here at the high. Price came up, swept above this old high, collected that buy side liquidity sitting above it, and then it reversed. And down here at the low, price came down, swept below this old low, collected the sell side liquidity sitting below that one, and then it reversed. Both sides here have been swept, and now that establishes the dealing range. Now let's mark the midpoint. This line here is equilibrium, something that I refer to as the 50 DRT level, but we'll get onto that at a later stage. This is fair value, right? Everything above this line, this is a premium, and everything below this line, this is a discount. Now here's how you use this. If the higher time frame context is bullish and price is currently sitting in a discount, this is where you start looking for buying opportunities. You don't go up here in a premium and start buying. You wait for price to come back down into the discount. Find support at a fair value gap or an order block or something down there. We'll get into that. And then you buy. Watch what happens. Price dips into the discount, finds support, then expands higher through equilibrium and back into the premium. That's the algorithm moving price from discount to premium. That's the rhythm of the market, and once you see it, it's absolutely everywhere. Now, here's why this is so powerful as a filter, because most traders are looking at indicators, right? Moving averages, RSI, MACD. They're trying to figure out if the market is overbought or oversold. But here's the thing. The dealing range gives you something far more precise. It tells you exactly where price is relative to fair value. Are you in a premium? Are you in a discount? Because if you're bearish and price is in a discount, you don't sell. You wait. The algorithm has to bring price to fair value, back to equilibrium, before it can continue lower. And if you understand that, you stop taking trades in the wrong part of the range. You stop selling at the bottom. You stop buying at the top. Your win rate goes up, not because you found a better technique, but because you stop fighting the structure and you just simply started to understand price. Now, let's talk about who's actually behind all of this movement. So now you understand the algorithm. You understand liquidity, you understand inefficiencies, you understand the dealing range. Now, let me show you the human dynamic that sits underneath all of it, because the algorithm doesn't move price randomly between these levels. There's a purpose behind every move, and that purpose is always the same: to transfer money from uninformed traders to informed ones. That is the smart money versus dumb money dynamic. And I want to be clear about something. Smart money doesn't mean some mysterious group of people sitting in a dark room pressing buttons. Smart money simply means informed money. The institutions, the funds, the people who understand how these markets are coded, who understand economic conditions before the public knowledge, right? And these people have deep enough pockets. And dumb money is retail. It's the majority of traders. It's most people who open a trading account and start pressing buy and sell buttons without understanding the system. And here's the key dynamic. Smart money always does the opposite of what dumb money does. When dumb money is scared and selling, smart money is buying. When dumb money is euphoric and buying, smart money is selling. And that's literally the whole game. Let me show you how this plays out on the chart. Okay, so here's a cycle I want you to walk through. Once you see this, you're going to basically see it everywhere, right? So here we see price in a consolidation. It's been building up here, ranging between these highs and these lows. Now, above this consolidation, there are buy stops, retail traders who are short inside of this range, right? They've got the stop sitting above these highs. And below this consolidation, there are sell stops, traders who are long inside of this range. They've obviously got their sell stops sitting below these lows. Both sides are loaded with orders. Now, watch what happens. Price breaks below the consolidation here. Every retail trader who was long, their stops are now triggered, right? The forced sellers are exactly this level. Smart money is on the other side of that trade. They're buying every single one of those stops, right? They're accumulating long positions here, using retail sell orders as the liquidity that they need. And then price reverses. It rallies back through the consolidation, back above those highs, and now retail traders who are short, their stops above those highs get triggered, and they're forced buyers at the top. And smart money who accumulated their longs down at the bottom is now selling to the retail buyers. They're offloading their positions basically to willing buyers up here. And then price drops because smart money has distributed their positions. They sold to retail at the top. That's the whole cycle. Sweep the lows, accumulate longs, sweep the highs, distribute the shorts, or the other way around. This is called offset accumulation and offset distribution, and it's the fundamental mechanism behind how price moves, but we'll get into more detail soon. Now, here's what shifts when you understand this. You stop reacting to price and you start anticipating it, because you know that before any real move happens, the algorithm needs to collect liquidity. So when you see price sweep below an old low, your first thought isn't the market's breaking down. Your first thought should be, who just got stopped out? Is smart money accumulating here? Is this manipulation before the real move? That shift in thinking from reactive to anticipating, that's the edge. And it's not something you find in an indicator. It's something you build by understanding how these markets actually work. Now, there's one more thing I want to cover before we wrap this up, because even with everything I've just shown you, there's still a reason why most people who learn ICT never make it work. And I think it's important to be honest about that. So let me be straight with you, because this is something I see every single day working with traders across all experience levels. Most people who learn ICT concepts don't make money from them. And it's not because the concepts don't work. They do. I spent nearly a decade studying them, right? I've worked with hundreds of traders and I've seen these concepts play out on every market, every time frame, every day. The framework is absolutely sound. The problem is how people learn it. And I think it comes down to three things. Number one, they learn concepts without learning context. Most people go to YouTube, they watch a video on fair value gaps, they watch a video on order blocks, they watch a video on breaker blocks, and then they go to the charts and they try to apply all of them at once. Let me show you what this looks like on a chart. This is what most traders' charts look like, and I'm not exaggerating. I've seen charts like this from students who've been studying for years, right? And every line is technically correct. Every level is a real ICT concept, but what does this chart tell you? Where do you enter? Where do you put your stop? What's the most important level right now? You can't answer those questions because there's no hierarchy, right? There's no filter. And without a filter, all you've done is replace one form of confusion with another. Now, this is what a chart should look like. Dealing range high, dealing range low, equilibrium. One or two key liquidity pools, one or two key inefficiencies. That's it. When you can look at a chart and immediately answer, where am I in the dealing range? Where is the next liquidity pool? And where's the nearest inefficiency? You literally have enough to form a trade idea. And there are ways to determine which inefficiencies and liquidity pools are higher in probability than the others. Not every inefficiency and not every liquidity pool has the same weight. Same with order blocks and breakers. But again, we'll get into that at another stage. But I really want to be honest with you here. Learning ICT concepts takes time. Not because the concepts are complicated, but because your eyes need to be trained. You need to go back through hundreds of charts, annotate what you see, build a library of examples until your brain can recognize these patterns in real time. That process can't be a shortcut. I spent years going through charts, hours and hours every single day before these concepts became second nature. But most people spend a weekend watching videos. They open a live account on Monday morning and wonder why it doesn't work. And that's not a method problem, that's a process problem, right? And number 3, they just don't have a framework. And this is the biggest one, because ICT contains hundreds of concepts, but concepts without a framework are just isolated pieces of knowledge. You need to know, what do I look at first? What's the sequence? When do I look for an entry? And when do I sit on my hands and wait for more information? That's the sequence. That's the hierarchy. It's what most people are missing. And that's exactly what I've built my whole teaching around. Because when you have the right framework, the concepts become simple tools. You know when to use them, you know when not to, and you know why. So here's where we go from here. This video was the foundation. Now you understand that price is algorithmic, that it only ever moves to liquidity or to fill inefficiencies, where liquidity lives and why price hunts it, what a fair value gap is, and how to read market strength from it, how the dealing range structures price into premium and discount, and how smart money uses retail as liquidity to fund their moves. That's the foundation. In the next video, I'm going to go much deeper on liquidity. We're going to look at how to build a full liquidity map on the chart, where the highest probability liquidity pools form, and how to use them to identify directional bias before you even think about an entry. If you found this useful, hit the like button. It genuinely helps more people find this content. Subscribe if you haven't already, and leave a comment below and let me know what part of ICT you found the most confusing. I'll be building this series around the things that actually trip people up. I'll see you in the next one. Good luck and good trading.